Hello there, fellow investors and TSP members. It's Scott, and I'm gonna start doing an end of week review of the indexes that the TSP funds follow, just to give kind of an idea how things are looking. I have a valuation system that I use for the S&P 500, which is what the C fund follows. I will show you about where I think the valuation levels are at the moment, and I can give you an idea of what to expect from the C fund, or what it should do if the market stays rational. But as far as the S fund and I fund and other funds are concerned, there's no I don't have a good valuation system for it. A good example there, the S fund follows an index that's managed by Dow Jones called the U.S. Total U.S. Total Completion Index, and it has over 4,000 companies in it. So, and smaller companies like that tend to be a little more difficult to get in earnings information from anyway, so I can actually make good estimates. So, I don't really have a good way to value the SRI funds, but stock funds in general do tend to have good correlation with each other on a day-to-day basis. They don't always go the same direction on any given day or by the same amounts, but more often than not, they're going to do at least move in the same direction. So, having said that, I'm going to show you some of the end of the week charts right now, and I'm only going to show you the daily charts. I don't go very deep into technical data like most of your average, like your typical swing traders or a lot of other investors will do. So don't expect to look at these charts and think you're going to see things like MACD, RSI, Bollinger Bands, histograms, or any of that kind of stuff. I do know how to use those, but I'm more interested in the fundamental aspects, which is based on earnings and economic data. So I'm only using a set of 4 different moving averages, and I'm only looking at the daily chart. So I'm not going to show you weekly, monthly, or yearly, whatever kind of charts, because my earnings system or valuation system, it depends on trailing 12-month earnings and forward 12-month earnings, and everything else is irrelevant to me. But it is a good thing to look at technical data at least a little bit, get an idea of what you might expect from a lot of the common retail traders. Okay, so I'm going to switch over to the chart views now. Now, the first one here you should see is the S&P 500. It closed on Friday at 2929.67. And my main interest here is showing you where I currently have the index valued on where its baseline value is. The baseline value or current value down here is around 2730. That's where I think the index is valued if there was no earnings growth to expect. However, there is expectation of pretty healthy earnings growth over the next year. So what that means is in the next 12 months, this white line here should climb up to about where this yellow line is. And as you see, that is currently at 31.20. And for the short-term trading range, I think what I call reasonable is staying in between these red and green lines. So if you're a shorter-term trader, normally something in between the dotted and solid red line is about the point where I would normally be selling out of my stock positions and going to G fund or cash. Well, I don't really swing trade my taxable account, but my TSP account I do swing trade preferably. So normally when I see it get into this range here is when I start going back to the G fund, and then when I see it drop down back into this green range here is when I would prefer to buy back in. As you can see right now, what I call a maximum reasonable value for it for the near term is in the 28.95 to 29.25 range. Feliciano He also does a lot of this data, and he has a little more current information than I have as far as the forward estimates are concerned. I believe he has his estimate right below 29.30 at the moment. So, in either case, the index closed at, or got up as high as 29.40 on Friday, but it did close just right below Feliciano's peak, I believe, or maybe just a matter of cents above his. I'm not really sure where exactly his number is. But either way, we're at what I think is a reasonable short-term peak. And then at this point, I would expect to see earnings growth uh, to justify either earnings growth reported or higher expectations for higher earnings than what are already expected for these numbers to climb upward. Now, if you notice, the solid red line here is about half the distance between the white and the yellow lines. There's a reason for that. Good example of this is, let's just say if you were to get a contractor to do some kind of home improvement job on your property. And, like a good example, a house I used to own, I had a deck built. It, a reasonable thing to do for the contractor is pay them half of what their agreed upon amount is up front, and then after they complete the work and it's to your liking, then pay them the other half. I like to look at the stock market as the same way, in a very similar way. Uh, so if we think that the yellow line is where hey, this is the end of the quote unquote project, then you should be pricing in about half of it. Half of where you're already at, up to or up to half of where the yellow line distance is, before you're saying that's enough to pay for it until they actually produce results. So try to think of it this way. This is how my system works. So at the moment, we're right there at the very top of where we really should be. In fact, we did get a little higher than I think we really should have been. Also, a couple days ago, Thursday, the index did gap up right here, as you see. I'm not looking at directly out my Thinkorswim window, and I don't have a zoomed in view, but basically this gray bar here is basically a gap that was created from the peak of Wednesday's close and the bottom of, or not, the peak of Wednesday didn't matter. It wasn't a close, but Wednesday's peak to Thursday's low point. Now, something that a lot of you who are swing traders and or anyone who has knowledge of technical analysis with stocks will know that usually when you see a gap created, there's a common saying that all gaps will be filled. So what this means is that if at some point in time, if this prophecy holds out, holds true, which I don't have a lot of faith in a lot of the stuff that that is supposed to happen, because it doesn't always happen, but pretty good chance that sooner or later the price is going to drop back down and fill that gap. Now, because it is a gap that's below the current price, it will probably become there's a better chance it'll become a level of support. So it means the price might bottom out there in that neighborhood and then work its way back up. I'd like to see it drop down a little bit more before the start of the next earnings season, which will really start kicking up in about mid-October. Once mid-October comes around and all the companies start to report updated earnings, you're going to see all of these lines push their way upward as the weeks progress. We'll get to that point later. This is more of just kind of a educational thing here about what I'm looking at, what you should be interested in, and all that. Speaking of, if you're a buy and hold investor, that 3120 level right up here is where you should really be paying the most attention to. The rest of the number, the red and the green lines are not really so much of interest to you. However, they might give you an idea when to expect to see your share prices and account balances drop a little bit if you are a buy and holder, or when they might rebound or something. But generally speaking, you always want to, the share price should always be somewhere in between the white and yellow lines, and preferably in between the green and red. When it gets above the red and closer to the yellow, we're starting to get on the irrational side, or what I call irrationally exuberant, if the yellow line's above the white line. At the end of the quarter, which will be coming up next week, I believe, yeah. I think the last trading day of the month and the quarter should be Friday, if I'm not mistaken. I'm not going to cover this stuff right now, but there are some details with that I will talk about next week when the end of the quarter comes. So watch for that. Watch for that information. But just keep in mind, if you're a buy and holder and you want to, and you focus on the S&P 500 as your benchmark or bellwether for everything else, which is what I do, then expect to see more gains over the next year. If you're a swing trader, it's looking, the prices are a little high right now, and I'm really not happy with seeing it above my red line here, but it does happen every once in a while. This is really only the second time I think I've seen it occur since I started using this valuation system. So, and I started doing this in, oh God, I want to say 2014 or 2015, something like that. So it's been a while. And only seeing it go over my peak twice, that's a pretty good track record, I think. So anyway, that should cover enough with the S&P 500 and the C fund for now. Move on to the S fund, which follows this index, DWCPF, which is the Dow Jones U.S. Completion Total Stock Market Index. This is not the Dow Jones Industrial Average, the one that everyone in the media and everybody else knows about. It's a completely different index. Dow Jones Industrial Average, the one you know, is an index of only 30 companies. They're all large cap, or what you call blue chip companies, and all 30 of those are in the S&P 500, which is what the C fund follows, not the S fund. This one here, it's just an index that's managed by Dow Jones, the company. It's not the Dow Jones index that you know. This one is a much larger index as far as number of companies are concerned. There are more than 4,000 companies in it, but the majority of them are all mid cap, small cap, and micro cap stocks. There are some large caps in there also, but only the ones that are not in the S&P 500 and which also meet the listing criteria for this particular index. Now, having said that, I do still favor the S fund personally. And this is based on economic data. I'm suggesting that most of the strength is coming from domestic sources, or demand is coming from the domestic side. So I still favor the S fund as a long-term play, or a medium or long-term, whatever you want to call it, play for now. When I do my regular monthly updates using the ISM reports, that's usually where I'll come up with possible changes of opinion about this. Now, the only other thing I really want to talk about here is if you're a swing trader and you exited the same day I did, right here, this red line is where I exited from the S fund. It was at 1485.49, which is right here. The very next day, or the following Monday, because this was a Friday here, the very next day it gapped up, but ended up coming back down and and then filling the gap, and then it looked like it was starting to set a lower high, not necessarily a lower low. That's another thing that a lot of technical traders will look for, is which way is the channel going. Right now, it's kind of channeling sideways on this end, but on a little bit longer term, it's channeling upward still. Looking at this way, it's still an upward channel as well. It's a little bit longer term view. It's more about a full quarter or so out versus what we only see here in maybe a couple of weeks. So with a shorter term view here, it looks like it possibly could be setting up um, a little bit more of a drop, but I wouldn't expect much to happen here because it seems to be holding support right in that 1475-ish range right now, and which I'm finding if it does get back down to that point on Monday, there's a pretty good chance I'll be making my next move to 100S or 100% S5. Now, the other thing that I am concerned about here is this yellow line, which is what I call the 50-day moving average, simple moving average, for those of you who are more technical chart savvy. Right now it's at 1466, and for every day that the price stays above the yellow line, or actually any of these lines, the more these lines are going to move up toward that price. Now, for those of you who have an interest in knowing what averages I use the red line is the 10-day, the yellow line is the 50-day, green line is the 100-day, and 200-day is the blue line. Generally, long-term investors who focus on charts like to look at the 200-day. And I'm going to show you something on the iFund or EFA or on the next chart here that'll kind of explain where some people will look at it, but I'll also give you a little fallacy on that. But anyway, the S fund I think looks good. It's going to find, it should find good support here pretty soon. So I want to try to get in this week if I can. If we really, I was kind of hoping to see anything in the 1465 to 1470 range at the very least before making my move back in. But I don't have much faith that it's actually going to get down that quite that far. And I really don't want to see the 50-day average catch up to it and create even more support. So if I see a drop on Monday back into that 1475 range, there's pretty strong chance I'll move my money back into 100% S fund on Monday. And make sure that gets done before noon if that does happen. Now, what was the next thing here? Okay, I think that should cover the S fund. Now I'm going to go ahead and move on to the I fund, which follows what you call the MSCI ETH index. Okay, EAFE or EAFE, that's an acronym for Europe, Australasia, and Far East. Now this index only tracks the companies that are originated in countries that are what you call the developed economic world. This does not include China, India, and a number of other countries that have large GDPs. That's only, I mean, there are quite a few countries in here that play a role in it. The two biggest players are Japan and England. Though Germany, France, and quite a few other countries are involved in it also. But Japan and England are the heaviest hitters in it. Now, I don't think the iFund should be in the negative for the year. I really can't explain why that's been happening. It's to this day still in the red. Now, this chart here, it only shows the ETH index, but I need you to understand that the iFund also factors in currency exchange rate changes involving those same countries. So the iFund chart, if you were to make an iFund chart, won't look exactly like what you see here. It could be completely a little bit different, but what we do know though is from the beginning of the year, the iFund has generally been down. It's almost a break even right now, but it keeps wavering seemingly between maybe about 4% in the negative to almost break even. Now, something I want to point out here. Something that happened that longer-term investors will look for, and even some swing traders. There's this point right here where the yellow line of the 50-day average crossed below the blue line, which is the 200-day average. This is in technical terms, is what you call a death cross. There are some people who believe that once you see that death cross event occur, that it's time to jump out of that fund. But in reality, if you see this, it gapped down before that even happened. I came way down here, and then when it actually crossed over, it was already way down here and coming over here. Looks like 66, 50-ish range, somewhere in that ballpark. Well, right now it's at 68, 63. It's still below that. Does that look like something that would benefit you if you were to jump out at this point? This is a reason why I don't like using death crosses and golden crosses as a means to determine trade decisions. Also, if you're in the main TSP group of mine, I have a file in there that talks very in more detail about these golden crosses and death crosses and why I think they're a ridiculous way to invest personally. It's I'm not against looking at them and seeing, using them as a gauge, but the gauge is just a gauge. It doesn't tell me everything just in one spot. There are quite a few other details present. And what I've seen is from the ISM reports, we're still getting expansion of demand for U.S. originated goods and services according to those ISM reports. It's just happening at a slower rate. So if there's still demand growth coming from foreign customers, then I really question why are we seeing a decline in share prices? Because if the demand is still growing from foreigners, even if it's slowing down, that tells me it's still growing. So if it's still growing, then the share price should still be growing, not going down. So I'm more than a little confused about why the iFund has been doing this. I don't expect it to give the kind of performance that the C and S funds have been giving, nor do I expect it to begin to catch back up to them. However, I think it's been oversold quite a bit, and there may or may not be some short-term growth potential in there, but for me, I can't explain why this is going on. So to me, the best thing to do is just nothing at all with it. It's unpredictable. I've given up long ago on really trying to put much into why the iFund does the things it does. But if you do want to play a little more of a risky game and hedge whatever, or take a bet that it might actually do something, knock yourself out. You might make some money in the iFund. In fact, I believe saw one or two people in the group talk about how they made fairly recent moves into the iFund, and they took advantage of this jump right here. Over the week, if I remember right, the iFund did jump more than almost 3%. That's on a single week. So they had some nice gains to take advantage of there. I don't know what they plan to do with them from there, and I don't know what the iFund will do from there either. So just know that I would say be cautious with this. I don't know what the rhyme or reason is sometimes with the iFund or EFA, or which is the ETF that follows this particular index. So it's a risk reward game you play here, and it's not one that I really care for myself, because I'd rather have my money involved in something that I can more easily explain or understand. And I think everyone should do the same thing as well. Okay, so I think that should cover the iFund for now. Now let's move on to bonds. The next chart here is the TNX, which is the chart that shows the 10-year Treasury yield. In reality, okay, as you see, it's 30.68. What this really means is that the 10-year yield is currently at 3.068%. The actual yield is always basically 1/10 of whatever this price is. There has been a lot of concerns in the media about bond yields getting above 3%. I'm not personally concerned about that. I'm more interested in what do the bond yields look like versus what do stock earnings yields look like. And right now, stock earnings yields are still very strong. I still have, I think, almost 25% growth expected over the next quarter. And then it should drop down to, I think, below 22 quarters from now, which is the was the first quarter of 2019. And then the second and third quarters of 2019, I believe I have in the 8.5 to 9% range, if I remember correctly. I'll go over those next week, though, when I do my end of quarter reviews. But even if it was the lowest of those numbers, like just say 8.5, 8.75, 9, whatever it was, well, 8.5 to 9% yield still sounds a lot better to me than a little over a 3% yield. So that's the reason why I would still strongly favor stocks for now. I only posted this here so we can get an idea of what the recent tendency has been for the 10-year yield, which is, the 10-year yield is more like the kind of the middle of the road in terms of length. It's a little toward the long side, actually, because there's, you only have the 20 and 30-year yields that are longer, but it's a little more smooth, I guess, in a way. If you were to ask big time investors like Warren Buffett, what Treasury yield or what Treasury note they pay the most attention to. I have actually seen an interview where Warren Buffett did say he would pay attention to the 10-year more than anything else. If there was only one indicator he could use for anything at all, he would look at the 10-year. So this is another reason why I like to look at 10-year, and it also is what I use as the basis for my estimate of how much should be invested in stocks versus bonds by using the ratio known as the beer. The beer ratio is always amusing to a lot of people who aren't familiar with that, but it really is a real investing related figure that people look at. When it stands for is bond equity earnings yield ratio. That's all it really does is compare the yields of the 10-year Treasury note versus basically the expected earnings yield of the S&P 500. And whatever that comparison is, basically tells more or less how much money should be, how much of someone's, what proportion of somebody's account should be focused on stocks versus how much should be in the bonds. Okay, so now that's out of the way. We saw that the 10-year note made a pretty good run up from, looked like right around the point where the 200-day is now at, which is about 2.82%, and it's climbed up to the 3.06 range now. Now there are some signs here that it's going to turn around and go the other way. For one, I'll show you what these things are that I look at here. When the price is starting to get so far up above the 10-day average, that's one of the things I see as, hey, the price is getting a little bit too high too fast, and the average can't keep up. So now what we're going to have more likely is a reversion to means. In other words, the price will probably drop back to or below the red line and recover. Now, the other thing I notice here is this last Friday night, Friday's close, whatever. There is a type of technical analysis called candlestick analysis, which is the type of lines you see here. Basically it shows the high and low points at the end of each stem, and then let's say this one here is the green line, green bar. The bottom of the green bar, the fat part or the candle part, is where the price opened that day, or the yield opened that day for this one. And when the market closed, it closed where the top of the fat part is, or the candle. Now, the wicks on the top and bottom end, basically what it says here is it opened here and then came down slightly and then found support and then shot back up and then came up here to the top where the peak was and then fell back to the point where it closed. Now, something here though, we have a doji. That's a term for this type of a candle right here. When basically the open and close price are the same, there is no candle present. And something else here, you notice how the stem on the bottom of it is much, much shorter than the top half? That's another sign that there's a lot of resistance coming right here in this high 3.0 range, almost at 3.1%. So there's a lot of well, for bond yields, they normally go the opposite direction as bond prices. So for the yield, this is what I call resistance, but for bond prices, that's what I would call support. You got to look at this backward compared to other charts when you're dealing with bonds, when you want to know what the bond price is going to do. So this could be foretelling that maybe the F fund might do something in the very near term. I don't expect much from the F fund at all in the long term, though. Not until bond yields get up to a point where we're starting to run into recession time, which I don't think is anywhere near yet. But it might be some kind of short-term gains that could be seen from the F fund. I'll be interested in seeing where that goes, but I wouldn't put my money in it personally still. But speaking of the F fund, I also have the chart that the F fund follows, which is this one here, AGG. This is the Barclays Aggregate Core Aggregate Bond Index Fund. This is iShares, but it's actually Barclays that it follows. Now, this index, it has quite a few different types of bonds in there. It's both, I believe, institutional, well, basically government and corporate bonds in there, and of varying lengths as well. So this isn't a perfect example, like perfectly backward version of what you just saw on the 10-year chart, because this factors in all the different types of bonds. But what we do see here, though, is there was a low point here at 105 back in, looks like, mid-May. And at the moment, it looks like it's finding support a little bit of, not too far off from that same point. Like, it looks like it might rebound as well, which is another hint that maybe the F fund might start doing something pretty soon, at least for a little bit. Now, also looking at this one, we see another death cross event over here. This is one of those cases where, yeah, following the death cross would have been a good move if you were a long-term bond investor, because it went down a pretty good amount. The death cross occurred over here in the, is that 109, almost 109.50 range, and it dropped all the way to 105. So it's a pretty decent drop. But short term, it's gone sideways since it hit that low point in there. So it looks like it's found some support, and it looks like it, in more short term, it's going to go up a little again. Now, this could be something of interest too. Once this yellow line, if it catches back up to the blue line and crosses back over it, that's what you call a golden cross, which is exactly the opposite of a death cross. And that's the point where bond investors might start jumping back into their bond funds, and because they might start seeing it as a more bullish sign. If they start buying more bonds, then the money has to come from somewhere. It's either going to come from cash or reserves, or it could come from existing stock fund positions. Basically, they'll sell out of stock positions and buy into bonds, which could cause a drop in stock prices. Or it could also be a case where money could be getting injected into the U.S. from foreign economies, which has been a not that unusual thing to see. As a general rule, the Treasury yields should generally go the opposite direction as bond prices, but go the same direction as share prices. But there have been plenty of times over the last couple of years where we've seen share prices and bond prices move in the same direction instead of the opposite direction. So, that's some of the little details there to watch for. Long term, though, again, I'm still not into the bond funds. I won't be at all until it comes time to where I really think bond yields are legitimately a better place to be than stocks. And we'll be much closer to recession when that happens. And I don't think we're anywhere near a recession, contrary to what certain people in the media have been suggesting. So I hope this hope you got some good information out of this. This actually went on a little longer than I thought it would. Wasn't really planning to go into much detail on this, but being this is my first one of this type that I'm presenting, I did decide it would be better to explain a little more detailed stuff than what I see here than what I might normally do on a typical week. Uh, I do encourage other people who do have who are more heavily focused on the technicals. Hey, share your information also. Clark Egan, I know you have a YouTube page that you post on. Please share your information on either or both of my groups. Jerry Huran, I know you run the Grow My Thrift Savings Plan group, and I know you focus heavily on the technical stuff also. I'm always interested in seeing what you guys have to say, even if my personal focus is more on the fundamentals. There are plenty of other people in the group who, there are both groups actually, who would benefit from whatever insights you guys have as well. So that's all I have for now. Just let me know what you guys think, and let me know if this helped you understand anything a little bit better. If you learned anything from this, and see you next week. Thanks.